Well, this paper is with Nick from Wharton. So the question is like, do common factors really explain the cross-section of returns? And we're going to be using new evidence that comes from high-dimensional data and some new techniques that we develop in this paper. So the big picture is that if you think about the fundamentals, what arbitrage pricing theory says is that securities earn higher expected returns only because they're more exposed to common or undiversifiable risks factors, right? There's nothing else. Like securities should not earn extra returns for idiosyncratic risk. That is the key point of APT, right? As a consequence, the expected excess returns of portfolios that hedge against all systematic risk should be exactly zero, right? And of course, arbitrage pricing theory is the foundation of all of these empirical multi-factor models for the cross-section of stock returns. That is, whenever you come up with a characteristics, for example, like say book to market, but find that it doesn't have like an infinite Sharpe ratio or a very, very high Sharpe ratio, we assume it's because it's proxying for some underlying risk factor in the APT sense. And in these papers, we're going to provide novel evidence contradicting APT's main predictions. But first, why is it hard to test APT? Well, there's two things that makes it like very hard. One is identifying common factors. So maybe we haven't found the right factors yet, and that is usually what happens if you think about this anomaly literature. Whenever we find a new variable that's predicting returns, it may not be the end of the world if we can find the correct model, right? And we've been iterating over the correct model for decades now, starting with CAPN, Final French 3, Final French 5, Lucenx models, Sandbox models, and all of these hardworking models. And the problem is that identifying all factors require estimating very, very high dimensional covariances, which is something we're going to address in this paper. The second part is that expected returns are generally unobservable, right? What we observe is realized returns, and we need to proxy for expected returns somehow. So our contribution is that we're going to combine three things. One is a novel method to measure individual stocks exposure to every common latent factor. So it involves a similar value decomposition of the return matrix, and it doesn't really need to estimate the covariance matrix. So we're going to get all of the exposures for every single stock. So the first critique that there could be a factor that explains it will not apply. Secondly, we're going to use out-of-sample measures of expected returns for each stock. We're going to use a broad set of public and firm-specific signals, and we're going to use rolling predictive regression, either linear regression or machine learning models in the search of return predictability. And finally, we are going to use a little bit of linear algebra to hedge all the systematic risk while sorting on the expected returns. We're going to do that using the pure place. Sorry. Search. Okay. Now, our main findings is going to be that portfolios that take less systematic risk performs at least as well in terms of returns than portfolios that take like more systematic risk. Or in other words, the systematic risk is not being compensated, right? We do find that the latent factors explain a considerable fraction, in fact, like all of it, of the time series variation of stock returns. But all of these latent factors carry either negligible or zero price of risk on average, right? And as a consequence, the latent factors cannot explain the cross-sectional variation in excess returns, right? Even though you can explain the time series variation, that is how stocks move together, you cannot explain within each time period why different stocks perform differently with this. And we're gonna exemplify this by constructing profitable trading strategies with zero ex-ante systematic risk exposure, right? Of course, our paper is related to the factor models literature. We're gonna be using machine learning predictions, and it's very much related in a deep way with the characteristics versus covariance debate. Which I'm gonna go well into that later. Of course, in the interest of time, this is a brief slide. And just so that everyone is the same page, what do I mean by arbitrage pricing theory? So this is a statistical model of returns. So without loss of generality, the first equation is valid, right? The returns are just gonna be an intercept plus a possible like individual fixed effect, plus some exposure to some latent factors, which could be possibly zero, plus some idiosyncratic risk, right? So at this level, it's without loss of generality. Now, the lesson of arbitrage pricing theory is that this individual effect better be zero or linearly spanned by the betas, right? Like there should not be any ex ante variation in returns that is not linked to factor exposures, because otherwise you can really diversify this with a long short portfolio and get an extremely high Sharpe ratio. And just to be super clear on how would you do that, of course, you would go long in portfolio with stocks with high expected returns, what I call mu-I in this case. So you would go long in this. Once you have a portfolio, the idiosyncratic risk essentially vanishes, and you would go long on portfolios with short on portfolios with very low expected returns or negative expected returns if it's the case, right? And of course, the idiosyncratic risk will also vanish. And the realized return of this long short portfolio is just going to be the differences in the expected return, what I call the differences in mu, plus the differences in betas times the factor exposures plus some idiosyncratic term that goes to zero, right? Of course, if it turns out that this beta of the stocks with high expected returns and the beta of stocks with a low expected returns is the same, then you're just going to end up with a pure, almost like a pure arbitrage portfolio, right? Like if the factor loadings are independent of expected returns, which is something that should not happen, then you're going to end up with portfolios with very, very high Sharpe ratios. And the portfolios Sharpe ratios are essentially going to grow at rate of square root of n. And of course, if we have 4,000 or 5,000 stocks in the cross section, that's going to be very problematic. Importantly, and what is often overlooked, is that this Sharpe ratio is not infinite, because in practice we do not have infinite amount of stocks, and the idiosyncratic variation of each individual stock is large, right? This idiosyncratic variation is essentially the amount that you cannot explain once you control for the common intercept, the individual stock intercepts, the betas exposures, and the factor realizations, right? And this is very much related to the amount of return predictability. That is the R squared of a regression of realized return on the expected returns. How much can we explain of that? Okay, so of course, normally people just take this to be an assumption and just say like, you know what, we're gonna build on this because otherwise weird things happen. What we're gonna do in the paper is instead, we're gonna actually test if this is the case, right? So we're gonna construct long short portfolios with very high dispersion in expected returns and zero systematic risk exposures. So we need two things. We need one, expected returns, right? Like which we're gonna use predictive regressions and machine learning for that. And two, we need like the covariances, the betas, which generally speaking involves a very high dimensional covariance estimation, because we're gonna do that for every stock in the cross section. So for the expected returns, we know that by definition, the conditional expected return minimizes the expected square error, right? Like that is literally the definition of a conditional expectation. So what we're gonna find is, of course, that's unobservable, but we're gonna try to proxy for that by collecting variables available at time t-1 and finding the best predictor possible. That is just a nonlinear predictor that tries to be as close as possible to the conditional expectation. In practice, we're going to regularize to avoiding sample overfit and make all of the predictions out of samples. So all of these portfolios can be constructed. All of them can be available at time t. Right? The minimization problem in practice, it depends on what technique you're using. So if you're using linear model, you would just project the realized return on some linear function. If you're using random forest, this would be roughly speaking what you're doing, even though it's non-parametric. And we also try with a Bayesian regression just to confirm. In practice, there is a significant amount of return predictability, right? It should come as no surprise, and it just appears like overwhelmingly like whatever specification you use, which is not problematic by itself, right? Because remember, there's always the hope that some risk factor can explain this return predictability. Now for the covariance, which is the new part, of course, like the details are in the paper, which is still preliminary, so you need to email me and ask me for it, but I'll be happy to share. We're gonna, normally you would need to calculate like a covariance matrix of the whole cross section of returns, and that's like a 2000 times 2000 objects, and then you would just need to project things carefully and extract the data from there, which is a little bit of overwhelming, especially when you're inverting 4,000 times 4,000 matrix, right? Which is singular at this point. So what we're gonna do this instead, and this is one of the contributions of the paper, we just noticed that if you take the realized matrix of the daily excess returns, you have to diminish it, but in practice, because the daily return of individual stocks is close to 0, it doesn't make that much of a difference. We're going to think about a singular value decomposition of that return matrix. That is, we're going to decompose the R matrix, the return matrix, into 3 matrices, U, S, D, and T, with some very nice orthonormal and diagonal properties, respectively. Then when we think about what is the covariance, well, the covariance is just RT transpose RT divided by 1 over n with size n cross n, which again is normally 5,000 times 5,000 because it's the whole stocks. We can always think about what would happen if we do the composition of that covariance matrix, and it turns out that you can decompose it into V, L, and V, and importantly, this V is the same as the one with the singular value decomposition. And I'm skipping all of the math in the interest of time and fun. But the punchline is that the betas, the traditional betas that we think about with respect to the latent factors, are all in the singular value decomposition. So you just need your return matrix. You don't need to transpose it. You don't need to do anything. You perform a quick compact singular value decomposition, and the rightmost matrix, the matrix with a V, will end up containing all of the betas for every single stock with respect to all the latent factors, right? In practice, there is a subtlety that is the latent factors are realized, like, at T+1. So technically the betas, because they're extracted with respect to latent factors, are only available at time T+1. So what we do is we just lag the values, or we just, so we use the past values so that everything is out of sample, or we try to predict the beta using a simple panel linear regression. In practice, the betas are relatively persistent, right? The risk exposures of every stock are not that much changing. Like, they are time varying, but they're time varying at the horizon of like 2-3 months, not at the horizon of 1 day. So we can get away with that. And we've done plenty of robustness checks to assess different situations. Right. So far what we have is the proxy for the conditional expected returns for every stock at every point in time, right? And the betas with respect to the latent factors of every stock at every point in time. Importantly, both of these subjects are going to be dynamically, so there is no excuse in saying, like, what, maybe there is some dynamic factors that explain the cross section. And the third step, which I told you is just a little bit of linear algebra. We're just going to construct portfolios with some properties, right? In practice, we're going to construct diversified portfolios that satisfy that they're like 0 weight, like net. So they're like long-short portfolios subject to the expected return being equal to some constant, some positive constant, just for normalization. And importantly, this is kind of like the newish part, they're going to be hedged against every single systematic risk. That is, the beta of the portfolio is going to be 0 with respect to the first, second, third, fourth, 5 principal and component, and so on. I think we use 50 for the main result of the paper, but honestly, the results are fairly similar after 10. So we do that, and it turns out there's a simple solution to this linear problem. What we do in later version of the papers is that there is actually a way to just construct long-short portfolios in the traditional way, and we confirm that the results are very similar to this, and also, essentially everything works. Like, there's just much return predictability, right? For the data, we're not going to do anything crazy. We're going to use CRISPR mostly in daily returns and composite variables and 1965 to 2015. In practice,
maybe jump in 5 minutes, Alejandro.
Thanks. In practice, we try predicting returns in many ways. So one specification is using Michael Weber's variables. Another specification is I'm just going to use, like, CRISPR variables. Another specification is I'm just going to use the WRDS financial ratios. Essentially, there's return predictability everywhere. So the results are very robust to however you like to predict returns. Right. And this is going to be the main result of the portfolio. So there's two things that I want you to look at this, right? Like, so we have the market return, the long short return, that is stock sorted on the expected returns that we find, and the beta, what I call the beta neutral return. That is like the stocks that are sorted on long short, but also are hedging all of the systematic risk, right? So the market return is just there for comparison. You know, like these are monthly returns, standard deviation of 4.6, Sharpe ratio 0.4, right? Like standard stuff. The long short, as expected, it has, remember, everything is out of sample. So it's not obvious that we would get excess return predictability, but we do. So like things work out of sample as well. Like, you know, the average return portfolio is like 0.70 per month. Standard deviation is 3.3 and Sharpe ratio is 0.75. Now that's a great portfolio, don't get me wrong, but there's nothing wrong from the theory point of view of that portfolio, because it still could be the case that there are some factors that can explain this portfolio, right? The problem comes here. Whenever we're hedging all of the systematic risk factors, two things should happen. One is that the average return should be 0, and of course that implies that the Sharpe ratio should be 0, right? But in practice, we observe the opposite, that the average return doesn't change at all when you hedge the systematic risk, which in turn implies that the standard deviation will decrease by half in this case, and which mechanically will double the Sharpe ratio. Now, this is extremely problematic for arbitrage pricing theory, right? Because it says like two things and two things only. One is that every difference in expected return should be driven by differences in betas, which we find is not true. And two, portfolios with 0 ex-ante systematic risk should get like 0 return. In practice, we observe like Sharpe ratios 4 times as large as the market, right? So that's the very, very bad news for the point of view of theory. I just the graphs are better presented in the paper, but you know, like just for comparison, risk-free rate is the black line, the market is the green line, and the long short is the red line. What I want you to observe is that the blue line is mostly hedging against all systematic risk. Again, because this is done on an ex-ante basis, there's still like some errors in the hedge, because you know all these portfolios are available in real time. But if you compare the standard deviation of the blue line with respect to the red line or the green line, like it's smooth for practical purposes, except for some periods where the betas just change dramatically and you do not have enough time to hedge for it, right? Now, when we break it into two parts, we observe something interesting, and I think I'm going to take like a slightly like extra 2 minutes, but not a lot more. So first is that most of the return predictability is concentrated on the period pre-2000. So if we break the sample, you know, pre-2000, post-2000, what we find is that the return predictability disappears after the 2000 for the long short, right? That implies here one of two things. One is that either the market got caught up, and you know the variables that were good at predicting returns at first like do not work later, or two is that these variables somehow started like becoming systematic risks themselves, and then you're exposed to the usual time series fluctuations. What we do find, again, like negative result is that even though the long short predictability completely disappears, once you hedge all of the risk factors, you end up again with positive returns and with a lower standard deviation and with a higher Sharpe ratio than the market. But at least it's decreasing in magnitude relative to the period. In some results that I'm not going to show here, when I use different variables, like instead of using the commonly known like variables to predict returns, if you just do like a kitchen sink approach and just put everything in there and regularize appropriately, the return predictability doesn't disappear. So that's the bad part. Right, so again, like this, what I was telling you, like, you know, pre-2000, everything is like going straight up. And then post-2000, the returns of the long-short portfolio are essentially very, very bad. The market was also doing bad, and even the beta neutral is not great, but it's still like a little bit decent, which should not be the case, because it should have return of exactly 0. We can also see this in the Thom-McBeth predicted cross-sectional regressions. They're essentially going to tell us the same things. So I would expect two things, and I know I'm over time here. Sorry about that. So if we just look at the whole panel, I'm just going to focus on that panel A. We should observe two things. One is that the predicted return has like a very significant t-stat, and two is that whenever we control for betas, the beta should have like 0 t-stat or no significant excess returns. And two, because of that effect, the statistical significance of the predicted return increases. So this is another way of looking at the portfolio returns, right? And finally, what I just want to show you is that when we form the portfolios, and importantly, we're forming the portfolios as long short. So for example, the portfolio would be kind of like a betting against beta factor, like long on stocks with very high beta with respect to the factor 1, short on stocks with very low beta with respect to the factor 1, and so on for the different factors. None of these factors seem to be priced, like none of them. So of course, that makes it impossible for them to explain the cross-sectional return, but that is completely against arbitrage pricing theory's prediction, right? And the intuition is that latent factors carry a very high variance by design, right? Like the principal components are literally constructed to carry as much variance as possible in order, right? And the problem is that hedging portfolios against all this systematic risk reduces their variation without reducing their returns, right? And of course, this implies that hedging portfolios against all systematic risk increases their Sharpe ratios. And because Sharpe ratios are almost 4 times the market, the Hansen-Jagan-Nathan bound not only makes it hard to explain for reduced for models, but good luck trying to get like an SDF 4 times as volatile in consumption asset pricing based models that also does not covary with the market portfolio. This is just what I was showing you earlier. They're essentially unpriced and carry a very high standard deviation by design. There's nothing here. And then finally, just almost as a mini test is like, can CAPM explain this? Of course not. Can FAM French 5 factor explain this? Of course not. Can any other reduced form model explain this? Of course not. By construction, because we're hedging all of the time series variation, although imperfectly, because again everything is out of sample, right? So this is the time series of the long short portfolio against CAPM. We find a huge alpha, so 0.75 per month. If you remember, that's exactly the amount of the unconditional return. So the CAPM is explaining essentially nothing. And once we hedge all of the systematic risk, the t-stat just doubles, because now you just have like lower standard deviation of the returns. And if you just try this on any other factor model, it should not produce any significant result. Right? Now, some important remarks that
I hate to rush you.
Okay, sorry, 1 minute. The result only applies to arbitrage pricing theories, and the results are consistent with return predictability and characteristic, not covariances driving the results, the returns. But this is still consistent with an SDF. It's just that APT is imposing extra assumption. And just to finalize, like taking 0 systematic risk should give 0 returns, but it gives us return as high as when taking systematic risk. And as a consequence, this is exactly the opposite of what APT predicts. Very low time series R squared with any model trying to explain it, but at least predictability seems to decline.
Okay, thank you very much, Alejandro. And let's promptly move on to Srihari Santosh from Colorado Boulder for the discussion.
Srihari, thank you for inviting me to, thanks for inviting me to discuss the paper. So my discussion is going to be a little bit weird. First, I'm going to tell you this paper has extremely thorough empirics. They combine a lot of techniques. They do a little bit, they do some new stuff, putting it all together. I have no complaints about the empirical execution whatsoever. So what's the punchline? You extract a few or even many important latent factors, which in their words explain essentially all of the common time series variation stock returns, but don't explain the cross-sectional average of returns, especially out of sample. That's what the conclusion I draw from the paper. And they conclude that this is a rejection of the APT. Now, I'm not as smart as Nick and Alejandro. APT gives me a headache. I don't know how to take n to infinity limits. So I feel lost. In life, when you're lost, what do? You go to the scripture. If you're religious, you use the 4 books on the left. If you're atheist, you use Richard Dawkins. But when you're lost in life, go to the scripture. What do you do when you're lost in finance? You go to the scripture. All right, so what does John say? John says, here's APT in a nutshell. Theorem, fix a discount factor m that prices your pre-specified factors. Then as variance of epsilon goes to 0, the price of any payoff is price of beta prime times, and it's the prices of the original factors. It got cut out when I was copy pasting from the textbook. Okay, add another theorem. As the number of primitive assets increases, the R-squared of well-diversified portfolios increases to 1. What does John conclude? The theorems tell us that the APT holds approximately in the limiting sense, either portfolios that have naturally high R-squareds or well-diversified portfolios in large enough markets. And so far, we've only used the law of one price. So this is page 178, chapter 9 of Cochrane's book. But then there's another theorem that comes after this. Theorem: for any non-zero residual, there is a discount factor that prices the factors f, consistent with the law of one price, and that assigns any desired price in the range on the entire extended reals to the payoff xi. So though the APT says if we fix the discount factor, as epsilon goes to 0, we can figure out the price of the asset. The reverse theorem says let's fix the residual and now search across discount factors, I can get any price I feel like, including minus infinity to infinity. What does John conclude? He says the lesson I learned is that you can't extend prices from original set of securities. ... To extend the pricing function, you need to add some restrictions beyond the law of one price. In this paper, they don't use anything beyond the law of one price. So John's conclusion is that you can say nothing about unspanned risk. So if I have factors that explain 95% of the variance, APT tells me nothing about the pricing of the remaining 5% without additional restrictions. And Alejandro got to this a little bit in the end. He said, well, the Sharpe ratio is 4 times that of the market, so therefore any consumption-based SDF you make is going to be BS. But you see, that's not APT. That's Alejandro pontificating on something beyond the APT, which I think that's what you should do. And so the paper is not really about the APT. It's about the APT plus enhanced Jagannathan bound is really what this paper is about, which is not what you're selling it as. So I like the empirical work. I'm just not sure that I like the conclusion that we reject the APT. What does Shri say? We talked about John, but now I'll give you my interpretation, which is how I like to give discussions. The APT is basically religion, not science. Taking the big N limit, Ross was having fun with math. Why? Because we don't live in an n infinity world. Remember theorem. In any finite economy, there's arbitrary pricing of the unspanned risks. Moreover, so why do I say the APT is religion and not science? Because the APT has no empirical content. It literally makes no predictions for the world in which we live, in which there are 4,000 stocks. It makes a prediction as n goes to infinity. It makes no prediction for finite n whatsoever. The APT literally makes no prediction for finite n, except that you should not find literal arbitrages. So we know something. When the second moment matrix of asset payoffs is invertible, we can construct the Hansen-Jagannathan SDF, right? Everyone remembers how to do this from basic asset pricing. Now, fundamental theorem of asset pricing. If an SDF exists, if and only if the law of one price holds, which is in a finite economy that's equivalent to no arbitrage. So the fact that I can construct, just literally take your returns, if the covariance matrix of returns is invertible, or really the second moment matrix is invertible, there is an SDF, which is the Hansen-Jagannathan SDF, which implies that the law of one price holds, which implies that the APT is not violated. So when we live in a world with finite number of assets and invertible covariance, you cannot reject no arbitrage. It's literally an unrejectable model. What do we call unrejectable things? Articles of faith. That is religion, not science. The only way to show a violation of no arbitrage is to show a violation of no arbitrage. You show me a trade that's an actual arbitrage, I'll believe in the violation of no arbitrage. Okay, listen, Shri, don't be so pedantic. Let's take the paper for what it is. Doesn't the paper kind of almost show a violation of the APT? So let's recall what the APT requires. It requires specifying some factors, and the variance of epsilon goes to 0. So let's look at these things in the paper. All right, so what are the factors? So extracting pervasive factors was what they call in the paper from the covariance matrix via PCA. So if you look at all APT papers, the math really goes back to like Chamberlain, Rothschild, or Connor and Karachik. You essentially need that as number of assets goes to infinity, the eigenvalues of the factor, suppose I think there's 12 factors. The first 12 eigenvalues should explode relative to the remaining eigenvalue. So the big N infinity requires a limit on the ratio of eigenvalues. It's essentially the thing you need to be able to identify these pervasive factors from PCA. So if you want to see a detailed mathematical treatment, look at Chamberlain and Rothschild or Connor and Karachik. As a little side point, if you look at Connor and Karachik, they do almost exactly what you're doing in your singular value decomposition. They do a singular value decomposition of the Graham matrix, which is R prime rather than R prime R. And they show you the link between the eigenvectors of the Graham matrix and the eigenvectors of the covariance matrix. So I'm not sure that the novel singular value decomposition is actually novel. I think Connor and Karachik has essentially the same math, if I remember correctly. Although, remember I told you I stink at big N limits, so the math of Connor and Karachik gives me a headache. Okay, so nothing in the theory tells us about the number of factors. So the authors, to their credit, say, we don't know the number of factors because the theory doesn't specify it. Let's try all kinds of numbers and see what happens. All right, so they hedge against 50 factors. The results are similar with hedging either against 10 or 100. Excellent. Let's look at the scree plot or the cumulative variance plot. All right, so how do we understand this? With 10 factors, PCA, basically 10 factors only explain about 20% of the total variation. With 100 PCs, it explains 80% of the total variation. That's a lot. But actually, is 80% a lot? 20% is still remaining of the variance. So are we in a world where we can claim that the variance of epsilon is approximately 0? Are we near that asymptopia? I'm not sure we're near asymptopia. 20% of the total variation in stock returns is a large number, potentially. So I just question whether the APT is a relevant model to understand what's going on in this economy. Now, let's look at the cumulative percentage of variance explained by the PCs. We can see the first PC is enormous, and 2, 3, 4, and 5 are also pretty large in eigenvalue. So the derivative of this curve is basically the eigenvalues, right? But then it's almost linear. It decays extremely slowly. So at 100, which is the maximum number that they use in the paper, we get to like 80%. But why not use 200? That gets me to nearly 100%. And if there's 4,000 stocks, 200 is still a small number of factors. I would encourage the authors to just, if 100 is good, 200 is good, because then we're much closer to asymptopia, where the epsilons are nearly 0, right? Rather than when the epsilons are 20% of the variance. All right, how do we understand this? So let's look at Kelly, Pruitt, and Su. You guys all know this paper, Characteristics are Covariances. What do they say? In their specification with 4 factors only, and all stock level intercepts restricted to 0, their instrumented PCA achieves a total R squared for returns of 20%. So they're using 4 factors that explain 20% of the variation in the total return space, and delivers a predictive R squared of 1.8%. So those factors do explain 1.8% of the cross-section of predictive regression. Remember, Alejandro told us that this predictive R squared exactly captures how much of the variation is being explained by these factors. Then they compare it to actual PCA, not IPCA. If you do PCA with 4 factors on stocks, that delivers 29% total R squared, which is higher than their 19% from IPCA, but it produces a negative predictive R squared. So they agree with you that PCA, which is effectively what you're doing, you're doing PCA out of the Graham matrix rather than out of the covariance matrix. They agree PCA delivers big R squares, but negative predictive R squares. So that's why they use IPCA, which delivers comparable total R squared for explaining time series variation, but delivers actually very good predictive R squared. So maybe this is the way to understand how to, I want to think about connecting your paper with Kelly, Pruitt, and Su. All right, finally, I'm going to have 1 minute. What's my recommendation of what to do? In the original APT paper, Ross recommended something like maximum squared Sharpe ratio of market neutral portfolios maybe should be bounded at twice that of the market in finite economies. Cochran tells us the APT without additional restrictions is not helpful. So good deal bounds, you guys know Cochran and Sarakawa, they're doing option pricing, or my own work with Sergey and Stefan restricting the cross-section, are examples of APT plus HJ restrictions in finite economies. So I think the APT is a straw man that's easy to defeat because it's actually, it's not easy to defeat because it has no predictions. But if I think we need to really take seriously the finite economy recommendation of Ross, and we all forgot it because it's in a footnote. Thanks.
Okay, thank you very much, Shri. Alejandro, would you like to take a minute to respond to any of the comments before we go to Q&A?
Yes. Thank you so much for the discussion of the paper. It's relatively early work. I still think it's not public, so thank you so much for for the comments. So there are some couple of comments. So super technical, but just we're using singular value decomposition in the return matrix, not in the covariance matrix or the gram matrix. It's not especially important, but it's technically novel in that way. Now, in practice, it's all the linear algebra, and it's not that relevant. Now, the second thing is that, I agree that technically APT is not testable. And if you're telling me we should forget about APT for justifying models, I agree with you. But, fundamentally, it is about like the fundamental part about APT is like those like increases in systematic risk, like, at least correlate with increases in expected returns, right? And at least we have very, very strong evidence, not just my paper, but like papers across time, that it doesn't seem to be the case. The principal components things, like we only have like roughly 252 trading days for the daily returns, because we're using time varying data. So that's why we roughly like try 100. I tried 200, returns are still similar, but at that point, the computer needs to embed a 200 times 200 matrix to form the portfolios. So things starts getting like numerically funny. But I think it's important to just go as far as possible and trying to hedge all the variation. The paper with Kelly is super interesting. And I think also what it shows and what's embedded in there is that you actually have to trade off time series predictability for cross-sectional predictability, right? That is the main message, because when you move from a world of PCAs to a world for IPCAs, it's not that you're doing it for free, you're actually decreasing the time series predictability. Now, my understanding of APT is that it's all about time series predictability, right? Even though I agree, we live in a world with a finite economy. And finally, while I value the Sharpe ratios, the priors about the restrictions, I think at the end it's an empirical question, right? So if we are able to find Sharpe ratios with like 2, 3, 4, 5 times the market, then I don't think we should be imposing that ex ante, but rather, it's a reasonable prior to have, but then you have to test if the prior actually corresponds to the data. But I really love the comments, and I'll be asking for the discussion to incorporate the comments.
I just want to say, I think I started with, I find the empirical work absolutely exceptionally well done, but I think we can actually draw more conclusions than just rejecting the APT. You have much to say about more. APT is kind of boring. You can say something about Hansen Jagannath and stuff about variance of SDFs. You have a lot more to say than just APT, I think.
Yeah, well, sorry, just to comment again. So I agree with you, but to me, the fundamental problem is that, we've been doing this thing of adding factors and factors slowly to explain the cross-section, and it's mostly because, and if you ask everyone, it's like, well, we have APT to justify that. So this is a paper like, you know what, you don't have APT to justify that. If you want to do that in a different way, like concurrences, like building an economy, that's fine. But you cannot just use APT like that randomly, and at least not test if it falls in the data.
Sure. And can I just say quickly, thank you, Shri, for the great discussion. And we agree with you, obviously, right? That the fact that APT in its raw sense is not testable for the reasons that you explained, but most people refer to it thinking really about the approximate APT, right, of Huberman and so on. And that's what people typically invoke, and that's what we're showing is not really invocable, because if you take it seriously, it doesn't work. Again, as you said, or as Alejandro said, you can get whatever good deal bound you want to impose, you're gonna blow through it if you hedge out enough common factors. So we're fundamentally in agreement.
I think we all fundamentally agree.
Yeah. And we should perhaps make it clear in the paper, but as Alejandro said, this is super preliminary. Maybe we kind of made a provocative statement to get things going, but this is a work in progress. But thanks.